Okay, everyone. Thanks for joining week. God, is this 8? I think this is week 8. It should tell me in just a second. Week 7 or 8 of RevUP. Today is a full breakdown of the lending process, which is, it's cool that we're doing this. There it is, module 8. It's cool that we're doing this right after last Tech Tuesday. So if you're watching this in at a different time, I suggest you go back to Tech Tuesday from December 1st, where we talked about lending in regards to COVID, and we covered a lot of what we kind of got a taste of what we're going through today. So today is really about the ins and outs of lending and being able to, at least on the surface level, speak with your clients about lending and the advantages of FHA versus conventional, or, you know, should somebody who has the VA eligibility, should they always do VA, or should they consider other options at different times? We're going to go into all of that. And some of it's going to be really basic. So, you know, if you've been in the business a while and you understand, you know, the difference between FHA, VA, and conventional, then sure, some of this is going to be like, yes, I know that. So bear with us on that, but we're going to get into some really good information on each topic. So bear with us there. I think this is a slide where I was supposed to say everything I just said, but yeah, this is what we're going through today. So as always, we start off our RevUP with a affirmation. So today's affirmation is: I love having counterbalance in my life and enjoy the knowledge that hard work in one moment allows me more play in another. I think I said it wrong. I'm going to say it one more time. I love having counterbalance in my life and enjoying the knowledge that hard work in one moment allows me more play in another. All right, guys, let's jump right in. We're going to talk about financing the sale, different mortgage types. So this whole meeting, I'm going to kind of be bouncing things back between Craig and I, and we'll just kind of be feeding off of each other. And I really would love for this to be like open mic too, right? If you have any questions about any of this, feel free to interrupt. It won't be interrupting because I just want this to be open, and any question, feel free to come out. But in general, there are 3 types of loans. You've got FHA, VA, and conventional. There's really a lot more we should talk about, and we don't have slides for, but I am at the end of the slides, I'm going to also talk about hard money loans. What's the difference between hard money and cash? What is hard money? Maybe we can briefly talk about USDA loans. I'll defer most of that to Craig because I actually haven't worked with one. I have a pretty basic knowledge. And then just kind of other different types of loans beyond this. But these are, in general, when you're talking to a buyer, these are the loans that you're going to be discussing with them: FHA, VA, and conventional. So let's jump right in. What is an FHA loan? So an FHA loan is a loan backed by the government. There is maximum loan limits. There are down payment requirements. So a general FHA loan is 3.5% down. And you know what, I'm actually just going to invite Craig in at this point. So Craig, how about you'll probably be better at explaining these. So maybe I'll let you kind of lead the way, and then I'll kind of voice my opinion in between. Does that work?
Yeah, absolutely. And so, yeah, there are the three major types of loans that you guys are going to see are going to be conventional, FHA, and VA. That's just where most people fall into those 3. USDA is not really commonly used too much unless you're going to be out somewhere where it's a lot more rural. And honestly, I am not the best resource for USDA either. We just don't do enough of them that I'm not the most, affluent in them, to be completely honest with you. So I would maybe seek that information from someone who does a lot more of them. Just full disclosure and honesty up front there.
I'll explain a little more about USDA at the end of the meeting. I'll give you just kind of a brief summary on what a USDA loan is, and then from there you can go to a lender who really specializes in it if you're working with a buyer who's looking in an area that it would qualify. So we'll just push that towards the end.
Yeah, a couple that you can look at too for that would be like Timberland, Washington Federal. They do a lot of that stuff. So there's some good resources for you guys to go seek out somebody for those loans. But all right, so where do we want to start with FHA?
Yeah, just start with FHA. Talk about loan limits and how it depends on counties, and how credit scores. Just the reason why would you go FHA versus conventional? What are the negatives and what are the positives? there's so much we can go into. So I just say, let's just jump in, and you and I will just I'll ask questions and we'll go from there.
Yeah, so we're going to go over just the basic, the conforming loan limits, basically. Let's start there. So there's going to be 3 different types of loans you guys fit in when it comes to those loan limits. You're going to have just conforming, you're going to have a high balance, and then you're going to have a jumbo loan going on. They're each going to have a maximum before you get into the next tier. So we just had the conforming loan limits for 2021 come out, but for this year, for 2020, you had 5, 10, 400 for conforming. Once you go $1 above that, you then jump into a high balance loan, which goes up to a loan limit of 741, 750. Once you go $1 above that, then you jump into a jumbo loan, which can go up to $3 million, depending on which lender and which program you're going with too. So, but for 2021, the loan limits are jumped up to 548, 250 and 776, 250. So really good, healthy increase of over $35,000, which is awesome, especially for our market going on. So just with an eye to the future, those are going to be the loan limits that's for Snohomish, King, and Pierce County, which are the major places we're going to be in. You can check out those loan limits online or get a hold of me and I can send them out to you too for each county throughout the state as well. So FHA loans, they are a government insured loan. The major benefit of this is if you have a lower credit score. So usually if you're between a 580 up to about a 680, that's where you want to look at an FHA loan. You're just going to have better terms and better interest rates going on for you. You only have to do 3.5% down up to the high balance limit of 776, 250 for next year, which is great. You can do down payment gifts from a family member, a friend that is truly invested in you. That's a little bit of a gray area, but a friend that is truly invested in you. Employers and unions sometimes have benefits, such as like the teachers unions usually will have a benefit in there. Is it the greatest program? Meh. But you can get down payment assistance from that or gift funds. You can also get it from a government agency like the Washington State Housing Finance Commission. Gift funds, they do refer to the contributions of cash or equity with no expectation of repayment. So it can't be like, here's a loan for your gift funds, but this is going to be repaid. There is no expectation of repayment when it comes to gift funds. The minimum is going to be a 580 for FHA for credit score. You are going to have an upfront mortgage insurance premium, which is actually financed into the loan. And that's of 1.75% of the loan amount, and that's financed into the loan. You are also going to have monthly mortgage insurance required on there as well. For debt to income ratios, so general rule of thumb, 45% is where you guys should really say stuff enters into, but you can go up to 50% depending on credit scores and which programs you're in. So if you're over a 660 for FHA, you can go up to a 50% debt to income ratio.
Can I voice in for a second?
Yeah.
I just want to make sure if someone is watching this and they don't know some of these terms, just really quick, debt to income, just to explain on a really simple level, what that means is what underwriting is going to look at. If you're a buyer who wants to know what you're qualified for, is they're going to take your total monthly income gross before taxes, right? And they're going to multiply it by 0.45. And he said if they have above 660, then it's going to be multiplied by 0.5. So it's half of that. And then they're going to subtract your monthly debt payments. And then that's what your total payment can be. So that's what debt to income ratio means. And what Craig is saying, just to be safe, even if you're not sure if they're above 660, or even if you know they're above 660, you don't want to overpromise and underperform, right? Get their hopes up. Just tell people it's a 45% debt to income, and hopefully Craig can come with good news, or your lender can come with good news and say, actually, we can go 50%.
Yeah, and kind of how Isaac and I were talking during the Tech Tuesday on the first two, know enough to be dangerous, never speak in certainties, and always refer to a professional just to keep your guys' hands clean of everything and keep your reputation intact all the way through.
Yep, love it. How are closing costs for FHA? Are they generally more than conventional or less than conventional?
No, they're all pretty much going to be like the actual closing costs themselves are going to be around the same, to be completely honest with you. The one thing, again, FHA is going to have that upfront mortgage insurance premium that is financed into the loan. So you're going to have a larger loan amount just because of that going on upfront in there.
Okay, yeah. So with a conventional loan, you're not going to have that upfront premium. And so when you're looking at how much you owe on a conventional loan, by the time you close, you're going to owe this much, and you're going to owe with the exact same down payment on an FHA a little more because there's a premium that's added on top, if that makes sense. Craig already alluded to this. Well, let's first talk about mortgage insurance, because this is a term that a lot of people are really confused by. So it's called PMI, it's called mortgage insurance. There's actually other things people call it, and I'm trying to blank. But regardless, what it is it is a payment that is literally insurance. And no one's the lender isn't getting the money. It's literally going to an insurance company that is backing your loan. So if you stop making payments, then that and the bank has to foreclose on you. The insurance company is covering the difference. If that you sell here and there's your loans here, they cover the difference. It's almost like gap insurance when you buy a car, except in this case, it's mandatory. You normally don't have to buy gap insurance. The biggest difference between an FHA and conventional in regards to mortgage insurance, well, two big differences. Number one, there's a higher premium that you're going to pay on FHA versus a conventional loan. So you're going to pay a higher percentage per month too, right? When you yeah. So a higher per month and a higher premium up front. So in general, just to simplify that, if you're talking to a buyer and they're like, why would I go FHA versus conventional or vice versa? You're saying this is a negative. You're going to pay more upfront for mortgage insurance and more monthly for mortgage insurance. And then the other big difference with FHA and conventional, the mortgage insurance eventually goes away. So just like if you buy gap insurance on a car, after 2 years, you can cancel the gap insurance because you have more equity in the car than you have owed on the car, right? Same thing with a conventional. It just goes away after 4 years.
Well, it's when you get to an 80% loan to value, you can call, talk to your lender, and ask for it to be removed, and it automatically cancels at 78%. But at 80%, you can call and request it to be dropped.
Got it. Okay. With an FHA loan, you're locked in. If you keep that same FHA loan for 30 years, it'll never go away. But I do explain to clients who need an FHA loan that if they're hung up on that, I say, well, you're not going to probably keep this loan for 30 years. I mean, I don't know what the statistics are, but how many people keep the same loan that they got when they bought the home? They almost always refinance, right? So that's not as big of a concern, but it's good to know, especially right now because interest rates are so low. I mean, the home that I just most recently bought, I'm kind of getting in the weeds here, but I paid part of my PMI up front because I knew that's a long story. I'm not even getting into that. My point is, I know that I probably will not refinance this for a long time because I got a rate of like 2.375, ridiculous. And I'm betting that rates are maybe never in history going to be this low again. So I went with that. And so that's one negative with FHA right now today over conventional is FHA, you get it to get the home, but you're probably going to want to refinance later because everything's a little more expensive on FHA. So your payment's going to be a little higher. And so it does kind of suck if you have to buy a home with an FHA loan. You're like, damn, I'm not really taking advantage of an incredible rate. I'll probably want to refi. So I'm kind of repeating myself, but just want to explain that. And Craig, I'll let you talk again.
Yeah, I mean, and to kind of feed off what you're saying, the average mortgage lifespan is between 5 and 7 years, guys. And then they refinance, they sell the home, or they just pay it off within that time frame. But the average life is about 5 to 7 years. So you got to remember that too. And so you can also use this as being like, hey, this is the stepping stone to get you in there. We're going to get your credit score up, which it will increase by owning a home because it gives you another piece of diverse credit history there that you can look at. So it actually will increase your credit score as long as you are on time with payments, everything like that, to get into that conventional loan so that they can refinance it if they want to.
Love it. Okay, so other FHA nuances. I think we pretty much covered the main things. It's always 3.5% down, unless someone wants to use a first-time home buyer loan, which is something that's another thing I've referred Craig for, because he's really good at educating people on that. You want to make sure, if you are encouraging a buyer to look into the FHA zero down program, which I'm going to let Craig talk about because he knows way more than I do about that. But you want to make sure you're referring them to a lender who does do it. Craig does do it, but a lot of lenders don't. It's like USDA loans and anything else. Some lenders do not have the capability of doing that. They have a license to, but they're not. They aren't. It's more, you have to have like qualification to do it, right, Craig?
Yeah, you have to be a preferred lender and actually go through the training and everything like that.
So a lot of lenders aren't. So anyways, Craig is someone who is, and Craig, I'll let you talk about the FHA zero down program, which is awesome. I mean, seriously, it's crazy. I mean, there are times in history where it comes back and then it goes away and comes back and goes away. So this is like such a great thing to talk to somebody about who, is paying $1,600, $1,700, $1,800 a month in rent, and they're just sick and tired of it, but they have no money in the bank. This is incredible. I mean, I'll let you talk, Craig, but it's such a cool program nobody knows about.
Yeah, it really is kind of like the hidden gem going on. And most people think that they have to put 20% down for their down payment too. They got stuck in that myth that their grandparents or their parents told them, and it's just not true. And houses appreciate faster, especially in our market. They appreciate so much faster than you can save up for a down payment. So every year it gets more and more expensive, and you're just falling further and further behind. The down payment assistance for Washington is through the Washington Housing Finance Commission. It is absolutely incredible. They will give you 4% of the loan amount to put towards down payment and purchase and closing costs. So, and it is technically a second loan, is what we call a purchase second or a bond loan. But it gains 0 interest over the life of the loan. It has a 30-year term. So it is only due back if you refinance, if you sell the home, or if you get to the end of the 30-year term.
So just to translate in really, really simple terms, I'm just going to break it into numbers. You're still buying a home with a 3.5% down payment. Okay. This is actually a comment when you're filling out the Form 22A, you're still filling it out FHA 3.5% down. You're just getting a loan, which is from a grant for the 3.5% down. So instead of having 3.5% equity when you close on the home, which isn't really true because there's other costs that are on top, but instead of having the equity, you have 0 equity because you've got a separate loan for the 3.5%. And again, it's a government grant, and that they only allow it for first-time home buyers. What are some other things that will eliminate you from being able to get this grant?
So you don't have to be a first-time home buyer.
Oh, okay. I didn't know that.
Yeah, you do not have to be a first-time home buyer when you use the Home Advantage, which is the only one you guys really need to know about. There are other ones, but Home Advantage is the most widely spread and the most commonly used. So yeah, you don't have to be a first-time home buyer. You just can't have another down payment assistance loan going on at the same time. You're only allowed to have one at a time. So you could have owned a home previously and used the down payment assistance. Now, if you still own another property and it's within a pretty close range of where you're buying, you probably are not going to be able to use it because it is FHA. So then you have an FHA guideline that says, hey, you have to be outside of a certain mileage to be able to use another FHA loan. So you do have those overlays going on as well. But the biggest thing is that you just have to have income of under $145,000.
Say it again.
$145,000 combined income.
Is that an individual or a couple?
Yeah, so just combined gross income is under 145.
It's surprising they don't have a different amount if you're an individual.
Yeah, it's just under 145.
Okay, surprising.
If you're making over that, let's be honest, you probably don't need to use down payment assistance program, but
true. Yeah. So let's just talk about how you can use this in your business. It's kind of obvious, but essentially what we're saying is you can literally, if you're talking to someone again who's paying ridiculous mortgage, they just don't have a lot of money, you can tell them that, hey, we can get a down payment assistance program. So you have a 0 down payment, and they're going to pay an additional 0.5% to your closing costs. Closing costs are around 2.5%. Let's talk about closing costs for a second. So buyers and sellers closing costs look very different. I'm going to be very brief here. So if we want to talk about this more, we'll probably cover it in future classes, but feel free to talk with me privately about this. But a seller is going to pay, the selling office commission, the listing office commission, excise tax. There's a lot that a seller has to pay. It's normally 8 to 9% of the sale price the seller is going to pay. The buyer is going to pay buyer's closing costs, which is generally around 2.5%. If you're in the lower price range, 300,000 below, it might be closer to 3%. So what you can tell, and that's loan costs mainly, title and escrow costs, even though that's not that much, but that's essentially that's how Craig gets paid, right? That's his commission partially. It's the banks making their fees and so on. So that's what closing costs are. But so let's say closing costs is 2.5%. Okay, you do the FHA down payment assistance program, so you got your down payment covered. You got half a percent of closing costs that you can throw at that 2.5%. So now we just need the seller to pay an extra 2% of closing costs. So factor that onto their 8% or their 9. And then your buyer can literally buy a home with paying for an inspection around $450, paying for a sewer scope around $250, and paying for an appraisal at $800, give or take. Don't quote me on those numbers exactly, but that's like $1,500. Like you can literally buy a home for $1,500. It's crazy. And people don't know this. People think that they have to have 20% down or at least 10% down or at least 5% down. And this is like, it's just an incredible program that if you have a buyer who thinks they can't buy a home, really push them and try and figure out, why do you think you can't buy a home? Because it almost always comes to down payment. They think they need so much more.
Yeah. And an important point in there too, because a lot of people are waiving inspections right now. You are not allowed to waive an inspection with using this program. They need to see the receipt from the inspector. So you have to have the inspections. That's one thing you do have to continue to put in there no matter what.
Yeah, this is a hard loan to get accepted. Let's be honest. This is not Craig, the owner here, not Craig who's on the call. Craig, the owner, always uses the metaphor of poker. He's like, cash is ace, right? That's an ace. That's the best hand you can have, the best card you can get. High down conventional loans, which we're going to get to, is like a king, and then a low down conventional is a queen, and then FHA and VA are tied for jacks, right? They're the least attractive type of loans. It doesn't mean you can't get them accepted. It just means if I'm a listing broker and I've got a bunch of offers, unless your offer is significantly better in other ways, I'm probably going to be going with the other loans. So this is good to let your buyers know, hey, this is the only way you can buy the home, and it's better to, we're going to have a rough time getting an offer accepted. That's fine. We're in this for the long haul. We're going to get you a home, but just know we are coming at this as underdogs, and we need to go in higher than other offers because they have better terms. Okay. Anything else on FHA, Craig, or can we move to VA?
No, that's a good outline of it all. But if you guys have any specific questions, by all means, reach out to me on any of this.
One last thing, if someone is complaining about, well, man, my FHA loan, the PMI is going to be higher, right? They're doing their own research and they see a PMI is going to be higher. Again, the best thing to do is not to compare it to conventional if someone can't go conventional. Yes, if someone can go conventional, almost always it makes more sense to go conventional. They got down payment and everything else. But if they can't go conventional, you're not comparing FHA to conventional because you can't do it. So it's not even an option. You're comparing FHA to renting. Right? And so that's the comparison here. So if I'm talking to a buyer and the buyer's like, man, I really don't want to do FHA, I can say, okay, well, here's your other option. You keep renting. How's that working out for you? Right? You're not enjoying that. That's why we're having this conversation. So just make sure you're comparing it to the right thing, because yeah, I mean, it's best, well, not really, but you could say it's best to buy a home cash. So are you going to save up for 10 years and then by then homes are quadruple the price? I mean, it's, just realize what the alternative is. It's, if they can't do a conventional, FHA is a great option because it does get you into a home. Okay, I'm rambling. I'm sorry, guys. All right, so the VA loan. So a VA loan is something that people who have served in any of our branches of service, what do you call that? Branches of
military
branches. Is that what you call it?
Yeah, branches of the military.
The military. Okay, just didn't sound right when I was saying it. So this is obviously an awesome program that is well deserved for those who have served for our country, and the benefit, first and foremost, everybody really talks about is there's no down payment, which is amazing. So they're literally getting 100% loan on the home. There's no, Craig, just feel free to interrupt me if I say something wrong and I embarrass myself. I've that's okay, but there's no PMI, right?
No PMI.
Yeah, no PMI. That's freaking huge. That's like $200 a month. That's huge. So generally, if somebody is eligible to use a VA loan, most of the time they should. There's very few exceptions. There are extra VA costs that the seller is required to pay. So guess what? That might make you actually more of a 10. If an FHA is a jack, that might make you more of a 10 because it's higher cost to the seller. Again, it doesn't mean you're not going to be able to help them buy a home. It just means it's going to be harder, right? They do have maximum loan limits, which I'll let Craig talk about. It depends on the county and depends on the year. It changes every year generally. Yeah, I'll let you take over, Craig. And then also, if you can talk a little bit more about what makes you eligible to get a VA loan.
Yeah, and so when we come to the loan limits, they're going to match up with the conforming loan limits of the county for the most part, as you see it going through there. So again, for going into the next year, 548,250, 776,250 for a high balance going on there. What makes you eligible is kind of this piece that a lot of people don't know a lot about. So during wartime, you have had to have served 90 consecutive days of active duty going on during wartime. Or you can have 181 days of active service during peacetime. If you're in the reserves and National Guard, you have to have 6 years in the National Guard or the reserves. A spouse of a service member who has died in line of duty or because of a service-related disability is also eligible to use those VOE, or the VA loan as well.
That's awesome. So kids and parents aren't, correct?
What was that?
Kids and parents are not eligible, correct?
Not eligible, no.
So like kids and parents can, I believe, get VA type discounts for insurance and things like that, but you can't get a VA loan. So that's just,
no. Yeah, that's correct there. One of the biggest things too that you need to have, or that a borrower needs to be able to present to the lender, is going to be their DD-214, which is just their discharge paperwork, which states which branch they were in, how long they served, and everything like that. And with that, the lender can then go get what's called the COE, the Certificate of Eligibility, which says what is their entitlement. Do they have full entitlement left? Have they already used some of their VA loan before? And so we'll go through all that too, and just basically says like, okay, you can actually put down, you can go 0 down, or you can't go 0 down on that. And if they're in case they are trying to buy or refinance, even if they are just if they have a disability rating, that means that they possibly can be funding fee exempt. So it's a really important piece to have there.
Yep. One cool thing about a VA loan as opposed to an FHA loan is FHA loans, as Craig mentioned, you can only have one at a time. So if you have an FHA loan and you move to another home, you're going to buy it, you have to go conventional, or you have to refinance the one with the FHA loan, and then you can go FHA again. You can only have one at a time. VA loans, you can have more than one. You just can't go over the total limit. So right now, I think it's like 740. Is that right?
Yeah.
740 in Pierce County. And so right now I'm pending with a buyer. I helped him last year buy a home, 0% down. We had the seller pay for literally all his closing costs. So he got a check at closing for his earnest money. Like seriously, he put in like 3,000 earnest money. He got that all back. And all he had to pay was about $1,500 for the appraisal and the 2 inspections. He's now renting out that home. He's been living in the basement, renting out the upstairs. He's going to rent out the whole home. And we're pending on another home that he's buying with a VA loan. That's going to be just, those two together are going to be just under 740. So another 0% down. We got the seller to pay all of the closing costs again. So in 2 years, he's going to have 2 homes that he's put barely any money in. We're talking seriously under $5,000 total. And he's going to be renting out one. It's crazy. Seriously, this is another one. If you are talking to anybody who everybody wants to be a real estate investor. That's like one thing I've noticed. Like everyone's like, yeah, I want to invest in real estate one of those days, but like nobody knows how to get started. These programs are like ways that people just have no ideas. People think like, even the people who know they can buy a home for 5% down, they still don't think they can be a landlord for that. You can. All you have to do is buy owner occupied with a VA loan or FHA loan, or we're about to talk about conventional, and then move. That's all my wife and I have done. We've never bought we never have had an investment property loan, but we have multiple investment properties because we've just bought a home, moved, and turned it into a rental, which is it's not complicated. And it costs like very little, if anything, out of pocket. So anyways, so it's such a cool option, and it's great that our country provides this to people who have served, because it's obviously well deserved. So, anything else you want to add about VA loans, Craig?
No, that's the major thing that you guys need to know. There's a little bit more that goes into it, but you guys really won't be talking about it at all. It's just more of the lender side of stuff. So that's a good overview of what you guys need to know going forward.
What about minimum credit score?
Minimum credit score is down. It kind of fluctuates depending with COVID going on and everything like that, but it's 580 to 620.
Okay, so pretty much same as a FHA loan in that sense.
Yeah.
And just like a conventional loan, your interest rate will be if you have better credit. You can always tell your buyers that, like, you don't pay PMI, so VA loan is definitely the way to go. Even if you have a down payment, it's still the way to go. And you can still get a very competitive interest rate, kind of like a conventional loan if you have good credit. So anyways, it's really like a mix between a FHA and a conventional. It kind of gives you all those positive things. I'm going to say one last thing about VA and FHA. Another reason why they are negative to a seller. Generally, the appraisers are going to be more stringent on value, and they're going to be more stringent on condition. And so I'm going to go really basic here. So again, just want to make sure we're covering all our bases here. So what an appraisal is, just to make sure you know this, is it's a third party. They don't work for the bank. They don't work for the lender, right? They don't work for the buyer or the agent. They're a third party that the lender essentially hires to make sure the home is worth what they're loaning, right? Actually is worth the purchase amount. So if it's FHA, it's got to be worth not just the 96.5% of what you're purchasing. It has to be worth the whole thing, right? Same with the VA. They're also making sure that the home is inhabitable, and VA and FHA will have tighter definitions of what inhabitable means. Like, they'll be more likely to say, hey, there's some of the siding, the paint's flaking off. A conventional appraiser will almost never call that. FHA, VA, I've seen them call that. All loans are going to call out, all appraisers, for regardless of the loan, are going to call out a broken window, but VA and FHA will call out things like potentially a window that the seal's broken. So it's like still keeping it warm, but it's not like a perfectly functioning window, which is ridiculous in my opinion. So my point in saying that, again, it's just one more thing that you can prepare your buyer for ahead of time and say, hey, we're working uphill on this because we have tighter appraisers as well as, the other things we already talked about. So I felt like I feel like I didn't really explain that super well, but hopefully that made sense regarding that. Okay, let's go to conventional loans. Conventional loans are pretty simple. You can go, there's 3% and 5% conventional loans, but then they go up. You use conventional loans when you're doing investment properties or vacation properties. All those other loans fall in the conventional loan category. So benefits are you're going to have lower PMI than FHA. The negatives are you have to have a higher credit score. I'll let Craig talk about what that is. You have to have, well, maybe I'll just stop and let Craig, you can kind of elaborate on it.
Yeah. So again, you're going to have the same kind of loan limits going on. So I'm just going to talk in terms of next year since we're almost there, and that's what we're really going to be focusing on anyway. So conforming limit of 548,250, you can do 3% down up to that amount. Once you go $1 over that, it has to be 5% down up to 776,250. And once you get over that, you're looking at a jumbo loan, which is going to be 15 to 20% down, depending on what program you're using and which institution you're going through. Higher credit score is required. It's a minimum of 620. Honestly, it makes no sense to go conventional unless you have a 680 or higher. And the 680 is kind of teetering on the edge, but it's where you do that comparison between an FHA and a conventional to see which one's going to have the more pros to it. So usually 680 or above is where it makes total sense to go with a conventional loan, but you can do it at a lower credit score too. You're just going to have a way higher interest rate going on. Like Isaac said, the PMI is going to be lower. You can actually do what's called a single premium or a split premium. where you can pay all of your mortgage insurance in a lump sum, and then you don't have anything in mortgage insurance monthly without putting 20% down, which is huge. Or you can do the split, so you pay part of it up front, and then you have a very low amount for what your monthly payment is there too.
So what does that look like, Craig? If we can break this down to actual numbers. So I'm buying a home that's $400,000, and PMI is generally going to be what, 150 a month on that price range, using really basic numbers, not holding you to this, but just so we can talk about like what's the benefit of paying no upfront, paying partial upfront versus paying all upfront. How do those numbers play out?
Yeah, so when you're looking at doing a single premium or a split premium, usually you want your credit score to be pretty high. Otherwise, the premiums can be pretty outrageous, and it makes no sense to do it. So usually you want about a 760 or higher when you're looking at doing a single premium or a split premium for your credit score. And you usually get a 60 to 70, you pay about 60 or 70% of what you would pay over the life of the loan if you just had your mortgage rates on there, but just in one lump sum. So you get a big discount going on with it. I usually amortize it out over 5 years. And if it's cheaper than paying the 5 years of mortgage insurance, it's a slam dunk. Do it. Get rid of it.
So just to break it down a little bit too, in this, someone has high credit, they've got more money in their pocket, and they want to keep their payment lower. So they're putting 5% down, they're paying 2.5% of their closing costs. And they're like, yeah, I still got money. Well, if they can pay their PMI up front, they're going to pay about 60%, give or take, of what PMI would be up until you can get it off your loan if you paid monthly, right? It's like anything else. If you pay something up front, you're generally going to get a better deal.
Yeah, absolutely. And like a good rule of thumb, what you're looking at there, depending on the price range, and if you're in that higher credit score, it's $5,000 to $8,000. This is a really cool thing where you can actually get this financed in by offering a little bit above the asking price, asking for seller credit back, and you can actually finance this into your loan. So you're not paying it actually upfront out of pocket too, but that's something you guys get to play with on that end. But it is something that can be done. So you can actually finance in your mortgage insurance premium as well.
This is just a great thing to not have to know. You don't have to know all that we just said. You really don't. All you have to know is this is a tool you can put in your tool belt, right? Your virtual mental tool belt. And when you have a buyer, and I've had two that I can think of who are just completely hung up on PMI. I don't know why, but every once in a while you get a buyer who's just like, man, it's just a waste of money. I'm just throwing it away. I'm just going to save up till I'm at 20% down. Because if you use a conventional loan with 20% down, you don't pay PMI. So I've had people say this, and I'm like, I show them numbers. I'm like, okay, how long is it going to take you to save up 20%? Okay, 3 years. Okay, well, let's look at how the market has increased. It doesn't make sense. Okay, they're still stuck on PMI. Well, let's talk to Craig about how you can avoid PMI. And like he said, you can, instead of offering 500 on a home that's listed at 500, maybe you offer 510, have the seller pay your closing costs, which you could have paid for, and then throw that extra money that they were paying at your PMI up front. Throwing a lot at you. So if, again, a lot of this, if it's not totally clicking, let's schedule another time to talk. But there's a lot of options. And the point is, if you have someone who's really hung up on PMI, there are other options. You don't have to remember everything we just talked about. Just remember that you can avoid it even if you're not putting 20% down.
Yeah, and this is a strategy that Isaac and I have talked a lot about. A lot of lenders don't utilize these premiums going on, but it's a really great tool to have, even especially in our market right now, with bidding wars going on and just what the home prices are going for. Because going back to debt to income ratio, so for every $100 in outgoing debt that you eliminate, it's about $17,000 in purchase price that you can then for, like more purchase price. So it's a way to go into the next tier of houses, or to be able to offer more on an escalation clause or anything like that as well. So it's a really great tool that you guys can utilize as well.
Another easy number to think of is what I tell buyers is, especially when they really love this home and they're offering 525, and the agent has essentially told me if we go 535, we'll get it. And my buyer's like, no, I don't want to pay more than 525. And they're approved it past there, but it's like, okay, why do you not want to pay more? It's about the principal. Oh, okay, tell them every $10,000 in purchase price is about $45 or $40 a month in costs, extra costs to you. So do you like this home? Like, is literally the payment at 525 literally the highest you'd be comfortable with? No, probably not. Would you go $40 more per month? Yeah. Well, then why aren't you okay going 535? It doesn't matter. It doesn't, anyways, just kind of breaking it down to smaller numbers like that, because $10,000 to a buyer is like, that's $10,000. Well, yeah, but it's really just $45 a month. And if they can't go 45 more, then that makes it an easy decision. Okay, we can't do it, and we'll move on to the next home. But if they can, it's like, don't trip over a penny to get to a dime. You love this home. What's the difference between a $2,100 payment and a $2,145? It's like, you could probably afford it. So I guess I guess the next, we'll just go through the next few slides, and then I've got a bunch of notes of things that, other general things that you should know in regards to lending. So common challenges. Craig, you don't even really have to talk about these if you don't want to, but what are some common things to know when you're talking to a buyer, that you can maybe kind of somewhat pre-qualify them? Again, we're real estate agents, we're not lenders, we don't want to give too much advice. But there are some things that someone can tell you, such as, yeah, I just completely switched industries. I just got into this and I used to do this and I've been doing it for a month. I'm making amazing income, so I want to buy a home. That's a red flag to me, because that's an industry change. We talked about this last Tech Tuesday, but that's an industry change, and you have to have at least a year of that on your tax returns before, and Craig will correct me if I'm wrong, before you can use that type of income. So what are some other things you can kind of listen for and educate your buyers on, without again giving too much information, but knowing enough to be dangerous?
Yeah, again, you can ask their, like, hey, what's the general ballpark of your credit score? The perfect borrower has a 720 credit score, has had the same job for over 2 years, has $50,000 in the bank. Awesome. Love that. That's very few people, unfortunately. You're not going to find that all the time. We all want to have that awesome vanilla buyer. We're not going to. Let's just be honest. It's going to be very few and far between, and just cherish those when you get them. But you can ask, ballpark, where's your credit score? Know that they're probably going off of like Credit Karma or something like that, which uses a different FICO model than what mortgage companies actually use when they pull your credit score. So I've seen a 40-point swing happen before.
20 points is very, very, very common. I haven't seen 40. Obviously, you approve way more people than I see, but that's crazy. And so, yeah, I always let people know. They say, yeah, I'm around 720. Just say, hey, just so you know, it can fluctuate apparently by 40. I normally tell people by 20. So just so you know, you could be as low as 7.
Yeah, just kind of prepare them up front. That's always something that I always do too. Just like, hey, just so you know, it's going to be a little bit different. It's a much more stringent model. There's 55 different models out there. It's ridiculous. Definitely, again, their employment, how long they've been there. If they are switching jobs left and right, that's not going to look great for an underwriter. They'd be like, they can't hold on to a job. Where's the job security here? So it does play a factor in there. So ideally, they have 2 years in the exact same industry. If they just got a new job, but it's like, again, I think we talked about this on Tech Tuesday. We had a client who was in sales. They worked at a guitar shop, and then went into still sales, but with Home Advisor. And it's like, okay, well, sales to sales, we can make that connection. So that's always something that I get to do on my end too, where I can make that case to the underwriter, like, no, it's still sales, and we're good to go. It's the same industry. Don't worry about it. So we can make those connections, but hopefully it's a 2-year history going on of work. If there are any, obviously knowing what their debts are, but you guys don't really need to ask that question. That's more for the lenders to get into. You can ask, like, hey, do you have a car payment? Credit cards, what do you think your payment is? So you can kind of run through the debt to income ratio that we kind of threw out there. And kind of do your own little pre-qualification there too, if you wanted to.
Yeah, and if you don't even want, you don't want to like step on their toes and ask personal questions. If you're not feeling comfortable asking them what they make and stuff, just give them what they need to know what they can afford. Just say, generally, I can't tell your interest rate. That's based off of your credit score. I can't even tell you if you're qualified. But generally, when it comes to what you'll be qualified for, assuming you check the other boxes, it's 45% of your gross income minus your monthly minimum debt payments equals what you total can afford. And remember, that total can afford has to be the property taxes, the principal and interest, the home insurance, and the mortgage insurance. All 4 of those have to fit in that bucket. And so that way they can go into it and be like, oh, wow, I can only afford $1,200. I'm probably not buying this year because I have too much debt. or my income isn't good enough. That way, you know, you can kind of save them a little bit of strife there. But ultimately, I don't like to tell my buyers, if they tell me anything, I don't like to say, no, it doesn't work. I like to say,
No.
you might have an uphill battle, but let's get you in touch with Craig and let's let him be the bad guy. Quite
Yeah,
simple.
no, yeah, exactly.
I want to be the guy who's there for them. Like, I'm going to be their shoulder to cry on when they can't get pre-approved right now and say, hey, I'm going to help you for the next 6 months until you are approved. You know, I want to be the good guy and Craig be the bad guy. Honestly, that's the truth.
No, and I'm totally cool with doing that. And it's never going to be a no going on. And that's an important thing too. And let me say, I guess the quote unquote no part of it, be like, hey, we're not quite where we need to be at, you know, but here's the roadmap to getting us there. You know, this is what we need to work on. This is what we'd love to see happen. So let's keep working on this all the way through. We're going to keep checking in with you and guide you through this entire thing.
I know I used the analogy earlier, but on Tech Tuesday, but really, Craig is your physical trainer for somebody who wants to run the marathon. Craig's helping train them, and he's not getting paid until you pass the finish line at the marathon, right? And that's why it makes sense. Yeah, that's why it makes sense. That's why I tell buyers, like, right away, like, even if you don't think you qualify, you really should talk to a lender up front. They're not going to make you sign anything and make you like sign your soul away, right? They're just helping you through the process. And so again, it's one of those things. I don't know why buyers get so nervous to talk to a lender, but gosh, once you do get that first consultation with the lender, they just have a pathway from there. You know, they thought they had to go this way, but now they realize they have to do this, and then they can go that way. And it's just so helpful. So anyways, just try and really encourage them to talk to a lender.
Yeah, and a big way to come over a lot of the objections too is just the educational piece, guys. Like that, like just be of value, give those educational pieces out there and provide that, and it'll open up the doors a lot of the time, all the way through.
Okay. Craig, do you want to talk? This slide's about loan estimate. The loan estimate, and the next slide is about closing disclosure. You want to talk about those?
Yeah, so loan estimate is exactly what it says. It's an estimate. Obviously, each title and escrow company are going to have different fees going on, so they're not all exactly the same. You can plug it in, but things might change throughout the loan as well. So you always say, hey, this is going to be your early estimate going on here. These are not final numbers going on, so please don't take these as they are set in stone. You won't have final numbers until we get a closing disclosure out to you. And even then, like, especially in this time that we're seeing where the volume is absolutely insane, a lot of times they cannot be balanced when we have to send them out on time. Ideally, every closing disclosure is balanced. It doesn't happen every time. But you will have a very good ballpark of where you're sitting at with the loan estimate going through there too.
And if you're working with the lender who just says, whenever you say, hey, what's an estimate of what the closing cost is? And they just say, just do 3%. And you ask them, no, I want to be a little more clear about it. And they say, no, just do 3%. Sorry, it's not a good lender, in my opinion.
No.
They're not going to know the exact number until closer to closing, but they should be able to be a little more clear based off of the price range and based off of the type of loan. And if they just say 3%, that's a lazy answer. And to me, it's a red flag. Honestly, it really is. To me, it's a lender who doesn't want to do a little bit of work. Like, I'm talking a little bit of work. That's it.
Yeah, it literally takes, maybe 10 minutes if you're drinking coffee or something in between to go through and like pull the actual property taxes actually off the county website, and maybe just run through a quick calculator of one of the escrow title company sites to get those fees. You should have them mostly memorized anyway if you're a lender, so you can just plug them in and be good to go with it. It doesn't take much work to do.
This is why it's so important. So many offers are won and lost by $1,000, $2,000, $3,000. If you're working with a buyer who needs at least 1% or 2% of their closing costs covered. Okay, so let's say, and I talk to Craig and I say, hey, what's my closing cost going to be? And he says 2.4, but instead I talk to a lender who says 3%, and we're talking about a $500,000 home. Well, what is 0.06 of 500,000? That is $3,000. So my offer could have been $3,000 better, and it would have cost us nothing. That's all I needed was a lender who just told me something, who just gave me an exact number, as opposed to just said the lazy 3%. So like, seriously, that cost us $3,000 and we lost the deal by $2,000. So it literally cost my buyer the home. And that's why it's so important. It's not a little deal. It's really, really important. So, okay.
Yeah. And one thing that you can do to definitely talk to your lender or, you know, whoever it is, ask them to do an exact scenario for the exact property that you guys are going to go look at before you go look at it. So you can actually have that stuff done up for you. So it's going to be really, really, really close ballpark. So, you know, if it ends up costing, you know, your client maybe like a couple $100 in closing costs, because it's off a little bit, dear God, they're going to be more than happy to pay that. And honestly, it's their earnest money that will probably cover it anyway.
Yep. Okay. Can you talk briefly about the closing disclosure?
Yeah, it is the most confusing form you'll ever see in your entire life. I hate this form. It was designed by a bunch of 50-year-old white dudes in suits at the bar one night, drawing it on a napkin, I'm pretty sure. It's supposed to be out there to be easier and put the information, so it's easier for everybody to understand, and they did an awful job with it. So it turns into what APR is instead of just interest rate. So you really have to dig through the closing disclosure and go through it with your client. But you guys don't do. I usually will sit down. I go through it with every single one of my clients because they are super confusing. But the biggest thing that people freak out over is they see the APR. And the reason that they do an APR is to also take into consideration the closing costs instead of just it being an interest rate going on. So people see the APR and freak out and think that's actually their interest rate. It's not. That's just APR over the life of the loan going on. It also shows what the most expensive portion of the loan is, which is the first 5 years of your loan. It's the most expensive part of the loan. It's where you pay the most interest going on too. So it does break all this down. Then it does break down closing costs and everything like that as well. But definitely make sure your lender's going over it with everybody.
Awesome. Lastly, I kind of want to show you guys, how to really quickly, if you're talking to a buyer who just doesn't possible for them to buy a home, maybe we've had a conversation about the 0 down program, or maybe they, want to go conventional and, pay off their PMI, whatever the case, they want to know like, well, what's my payment going to be for this home that, I just saw on Zillow, I really like. Okay. So I really encourage you to do this, especially if they're having trouble. If you're having trouble getting them off the couch and talking to a lender, they just keep sending you homes, but they don't want to get pre-approved. Have this conversation. So I use bankrate.com, but there's your app on your for our Realty One Group app, your Realty One Group website. There's all kinds of mortgage calculators. I really like the one on bankrate.com because it's a little more customizable. But mortgage calculator. But again, you can do this on any mortgage calculator will do this. So let's say they're looking at a home that is 525, listed at 525. Where this is again another reason why it's so important to talk to a lender first before you do this, but they're for some reason really pushing back. They don't want to talk to a lender, and you say, okay, well, interest rates are around 2.75 right now, but it could be a lot more, it could be less. So, you want to be careful when you're doing this, right? You don't want to say you're probably gonna be around 2.75. You say that's around the norm right now. It depends on your credit score. They're doing a 30-year loan as opposed to 20, 15, 10. This is one feature that a lot of mortgage calculators don't have. That's why I go to this website. And then they want to do 5% down conventional. So you can show them, okay, so it would be $26,250 out of pocket, plus about 2.5% for closing costs. That's the general rule I use when I'm just trying to talk to them. Or we can get the seller to pay your closing costs. And so that's a principal and interest payment of $2,036. Homeowners insurance is about $75 a month. Property taxes, you can look up on the listing, see exactly what property taxes are. This is just doing an estimate. And I thought this tab also had PMI, but it doesn't. That's frustrating. So you can add PMI here. Yeah, well, shoot, I generally like to use a calculator that does calculate PMI because it's a really important thing to calculate. So never mind, don't use this one. But anyways, mortgage calculators are such an easy way to excite people because then they go and they're like, wow, you're saying I can pay $25.75 and get this per month and get this home that I'm in love with that I just saw on Zillow. Now it just all of a sudden became really achievable to them. And they're like, wow, we're paying $2,200 to rent this 3-bed, 2-bath home, that we don't like. And it's like, wow, that just became really achievable. And you just showed them real numbers. This isn't an estimate. If they get the home for this down I mean, for this price with this down on a 30-year loan at this interest rate, this will be their principal and interest payment. It's a mathematical equation. Does that make sense? It's not like this isn't an estimate. That's a literal number based off of a 30-year amortization. So anyways, I highly encourage you to use mortgage calculators whenever you're talking to a buyer, because these numbers, they excite people. It goes from being super hypothetical to being like, oh yeah, that I can do that. I can afford that, or I can't. Right? Or I can't. And so let's look at what 400 would be. And then you go 400 with 5% down, 30-year, 2.75. Whoa, what just happened there? And now you see, oh, okay, that's more achievable. I was looking to be under 2,000. Okay, well, perfect. So now we know this is the price. This is a range that we want to be around. Now let's go talk to a lender, right? This is, again, not to pre-qualify your buyer. This is to get them so excited that they feel like they have to run to the lender and talk to them. That's kind of the whole point of this. Okay, well, that's about all I have. I do have a few. I just want to talk really briefly about USDA loans and then multifamily loans. And then if Craig, you have anything else to add, we'll do that. We'll do some question and answer. But I pulled it up on my phone really quick. So basic requirements for USDA loan: you do have to be a first-time home buyer, a literal first-time home buyer. You can't be someone who bought a home and now doesn't have a USDA loan. Like, it has to be the first home you bought. That's important. It has to be in a rural, which is a really hard word to say. I always struggle with it. A rural area, which is vague. So that's why it's like, talk to a lender, right? There are not a ton of places in Pierce County, but there are some. So talk to a lender. It has to do with the amount of the population in an area, and they actually have maps that they can pull up that can tell you if it qualifies for that. And then they have to be under a certain income. And the benefits of it, there's a lot of benefits, actually. It's zero down, right, Craig?
Yeah.
Zero down. They have lower interest rates, actually. It's like there's a lot of really, really cool benefits. So it's good to have a USDA loan lender. If for no other reason than if your buyer asks about it, you're not like, I don't know, let's Google it. Like, at least then you have that in your pocket that you can give it to somebody. But it is a cool option. It's just there's a lot of different things you have to qualify it. So now you know enough to be dangerous, but get them to a lender who knows what they're doing, and network with lenders who know that. Maybe Craig, do you know a lender, or you already mentioned at the beginning a few to call?
Yeah. So WaFd, Timberland. I don't have anybody specific there anymore, but reach out to them. They do a lot more of that than obviously we will. One of the big things to know is that there are pretty strict income limits when it comes to USDA loans too. Like, it's like for a family of 1 to 4, you have to be making under $90,000 or something crazy like that. I don't know the exact number, but it's around there. Like, there's really strict income guidelines on it as well.
Yep, it's a government incentivized program to incentivize people to buy in areas that are that are less populated, right? They're trying to encourage people to spread out of the cities, and then they're also trying to help people who maybe would not have been able to buy a home without a USDA loan. So it's a really cool program. There's just a lot of check boxes. But again, this is just another thing where if you're talking to someone who's just like, yeah, I can never buy a home. Well, why don't you think you can buy a home? Well, we only make 60 grand a year. Well, where are you looking? Oh, I'm looking in Graham. Could be, I mean, that could be an option. I actually don't know if Graham qualifies. I would think it does. It's pretty rural, but who knows? Maybe a little outside of Graham. I know there are places in Pierce County. I had a buyer 2 years ago that was looking, and I know there are places. So anyways, it's a good thing to know just a little bit enough to get them to a lender. Lastly, let's just talk briefly about multifamily loans. I love multifamily because I love house hacking. So house hacking is a term, I think it was coined by Bigger Pockets. Bigger Pockets is a real estate investing website and podcast. Great resource if you're interested in real estate investing. But a lot of people don't know this. You can buy a multifamily home, and multifamily being 2, 3, or 4 units, with an owner-occupied loan. Crazy. So VA, you can literally buy up to 4 units, can't be 5 or more, and do 0% down. And with that VA loan, qualifications are, oh God, Craig, you're going to have to help me on this one. Is it just FHA that has to be the 75% on rents, or is that?
Yeah. So you have the self-sufficiency test, which it kills a lot of the multifamily stuff. So whatever the rent would be, you can take it at 75% of what it is. that has to cover the entire mortgage. If it is even short by $1, the deal is dead. It will not work. It will not go through.
But the point is, if you are working with a buyer who wants to be an investor, and they're like, yeah, I'd love to buy a duplex and live in one unit, have somebody pay my mortgage. I mean, that sounds great? It is great. First off, that was the first home we ever bought was a fourplex, and probably one of the best decisions I've ever made. It's an option out there. Again, just another thing. It's not going to work for every buyer. If you got a buyer who's like, you think that'd be a good fit, it's one of those things I feel super excited when I find a buyer who is interested in that, because I just know that 10 years down the line, 2-3 years down the line, they're going to be so happy they made that decision. And it really makes me feel great when I help somebody get a multifamily property, because I know that's going to be life-changing for them. Honestly, I'm very, very passionate about it. But we won't go into too many details. Just know you can get a multifamily loan. It has to be under five units, so 4 or less. And there are other qualifications. So talk to a lender if you want to learn a little bit more about that. If it's more than 5 units, then you have to get a commercial loan or hard money or cash. Commercial loans are difficult. It's literally technically a commercial property if it's 5 units or more. It's an apartment at that point. You need a commercial loan, which is, I don't think there's any commercial loans less than 25% down. Your interest rates are higher. Your amortization rate, they don't do 30s. They do 25 on the high, I think, maybe not even that. But 15, 20, 25. And so that means your payment's going to be higher, right? Because it's spread out over less time. So there's a lot of different things. There's also not a ton of commercial lenders. I know a few who are really good. So if you have questions about that, let me know. Also, as a real estate agent at Realty One Group, you have to partner with Craig or I on your first couple commercial loans, because there's a lot to them. So anyways, if you're working with someone who's interested in commercial, talk to us first. Let's talk really quick about hard money loans, and then we'll wrap this up. Hard money loans are they're essentially like cash. Okay, so it's not a traditional bank. It's a private investor or investing company. So there's lots of companies that do this, and essentially what they're saying, what you're saying, let's say, Christy, you want to buy a property that won't be financed. And by won't be financed, I mean there are issues with it such that an appraiser would not appraise the home due to condition concerns, right? The siding's falling off, there's no flooring, there's broken windows. It can even be one of those things. So you can't get a loan. So the only way this home can be purchased is with a rehab loan, which we didn't talk about. There's never enough time in these, but a rehab loan or a cash deal. And so a hard money loan is essentially getting cash from a hard money lender that then you can go buy a home cash. Now, because it's a very risky loan in the sense that they know, well, it's not even necessarily because it's a risky loan. It's also because the hard money lenders know you're talking to me because you can't buy the home without me. There's no other option. Like the only other option is other hard money lenders, right? So they charge ridiculous rates. They charge things called points. That's where 1, 2, or 3 points. And that's where you get a loan for $200,000. And they're going to charge you points up front or points when you pay off the loan. And a point is 1 point equals 1% of the loan. So you're going to pay your interest for a loan, plus when you pay it off or when you upfront, you're going to pay X amount of points. Oftentimes they're charging 2.5%, 3%, 4%, 4 points before or after. Then they're going to most of the time require 10 or 20%. And then they're going to, or sometimes they'll say, hey, we'll fund the whole purchase. So let's say you're buying a property that you're going to flip and it's $200,000 to purchase it, but you're going to put $80,000 in. They'll say, hey, we'll give you the whole purchase, but you have to pay for the rehab. And then they have really short terms. It's still amateur. You're generally paying interest-only payments, right? So you get $200,000 loan. You're just going to pay the interest on it. So your principal is not going down every month. You're just paying what $200,000 per year divided by 12 months is every single month, and until the flip is done or whatever, until you can refinance it into a normal loan, and then you're paying them off plus the points. And lost my train of thought for a second. I guess, I was just going to say, they normally have really strict balloon payments. And what a balloon payment is, is they say after 8 months or 10 months or 12 months, they generally don't go above 12 months. The whole loan's due. So you have to refinance it or sell it at that time. And if you don't, the interest rate goes from 11% to 18%. Like seriously, it's ridiculous. And an extra 4 points are tacked on. I mean, they hammer you hard, and they can. So it's one of those things that if you're working with somebody who wants to invest in a property and it is an option, it's just, there's a lot to it. It's difficult. It's risky, not for the faint of heart. And it is an option though. So definitely feel free to talk to me if you are working with a buyer who's interested in this. Craig, anything you want to add?
No, I mean, definitely what you want to do is you want to be able to refinance out of that hard money loan. So obviously get whatever renovations you're doing to raise the value up so that you can actually do that cash out, because it is going to be a cash out loan for to refinance that. So you need to take a look at that and make sure that you're sitting there where you need to be at all the way through.
Yeah, so that's a really good point. So I'm sorry, I do think that's something that needs to be elaborated on. So what you're saying is, so if I'm a flipper or just somebody looking to buy a property, remodel it and rent it, you're looking at two things. You're looking at a lot of things. You're looking at what's my acquisition. Okay, it's 200,000 plus what's my rehab. And that's normally that's not our job as agents. We're not lenders. We're also not contractors, right? Your client should be estimating their own rehab costs. Okay, so your client says, hey, it's going to cost me $80,000 to have this into a beautiful home. Okay, now it's my job as the agent to go to them and tell them what I think it'll be worth after they put 80,000 into it. And they tell me, yeah, it's gonna be all new flooring, it's gonna be new windows, it's gonna be new roof, new siding, all new paint, it's gonna be gorgeous, right? So I'm looking at flips in that area and I'm like, okay, that's perfect. I think it's gonna be worth 340. Okay, so now what they wanna do, and generally a client like this will know this, but what they wanna do is a cash out refi. The max you can get on a cash out refinance is 75% of the value of the home. So if I think it's worth 340, we're going to go 340. I don't know if you can see my phone, but 340 times 0.75, and that's 255. So those numbers don't work, right? Because they are buying the home for 200, they're putting 80 in. So that means they're going to have $25,000. Yep, I did that right. 25,000 stuck in the home. They're okay with that. That's fine, but just let them know. If they want to flip the home, the way they're going to do that is we're going to go, okay, it's worth 340 times, I'm going to go times 0.91 because I'm taking out 9% cost to sell, right? Because again, this is getting really into the weeds, but the seller is going to pay 8 to 9% when they sell a home, okay? They're going to pay the listing broker, the selling broker, all those other fees. So being conservative, I'm going to say 340,000, what I think it'll sell at, times 0.91. Okay, that equals 309,400 minus the 280 that we've put in, and their total profit would be $29,400. And so then again, that's where it's like, it's not my question, it's up to you, my client. I say, are you okay with the 6-month flip be making $29,400? And they're probably going to say no, because that's like $5,000 a month. Anyways, that's kind of how a flipper or a buy and hold investor is going to look at it. But I just wanted to explain that your job if you're representing one of them is, so bring them deals and then ask them if they're interested, say, okay, what's the rehab going to be? And then try and help them figure out, is there enough margin there that it's worth the risk? Because it is a risk. All right, that's all I got. So as always, we conclude RevUP by talking about the one habit. This is just something I encourage you to add to every day that you commit to working, making 3 phone calls, adding 3 people to your database, and sending out 6 handwritten notes. If you want to cheat on that, those can be emails or texts. But essentially, the idea is adding people to your database, having personal conversations, and sending out content to people every single day that you work and sticking to it. It's one of those things that if you go through the motions, you do this every single day, it's just like planting seeds. You're not going to see the sprouts right away, but it will come back around. All right, everybody. Thank you for joining. Any questions? I should have said that at first. I know it's just Chrissy and Anthony right now, but any questions from anybody?
No, I'm fine.
Good deal. Well, thank you everyone for joining. We'll see you next Tech Tuesday. Thank you.
If you guys have any questions at all, feel free to reach out to me, shoot me an email, or give me a call, shoot me a text at 206-512-0047. or you can hunt me down on Facebook like Christy did. So you can always find me there too if you want to.
It
Whatever
works.
modality you want to use to find me, go for it. I think Isaac will be sending out my contact info as well with a follow-up email. So you guys can just feel free to reach out to me whenever, okay?
Yeah, I apologize.
Awesome.
I led with that. Thank you, Craig, for being here. And his contact information will definitely be in the recap email. And so, yeah, Craig is great at what he does, and we appreciate you, Craig.
Thank you so much for having me, guys. Really appreciate it.
All right, guys.
Bye.
See you all later. Bye.
Bye, guys.